Here's what you need to know about how long to keep your tax records, because tossing them too early could come back to haunt you. If you've got a drawer full of old tax paperwork and you're wondering when it's safe to shred it, you're asking the right question. The general rule is 3 years. That's the minimum amount of time you should keep your tax returns and supporting documents. That's because the IRS has 3 years from the date you file to audit your return or assess additional tax. But there are exceptions. If you made an error that resulted in you underreporting your income by more than 25%, the IRS could go back 6 years. And if you've never filed a return or filed a fraudulent one, there's no time limit. They can audit you indefinitely. There's also a 7-year rule if you claim a loss on bad debts or worthless securities. And employment tax records, you'll want to keep those for at least 4 years after the tax is paid. And don't forget, if you have property like a home or investment, you'll need to keep the purchase records, improvements, and other related documents until you sell, plus a few years to cover any audit window. Bottom line is, tax records aren't just for taxes. They're your defense if the IRS ever comes calling. And in California, where documentation is key, having those records ready could save you from major headaches later on. Need help with your tax situation? Call our office today for a free consultation. We'll review your case and help you take the next steps with confidence.